Okay, so today let us revise first receivable management, debtors management, part of your working capital management topic. So there is not too many formulas here, but still I'll give you some basic formula you will keep in mind. Okay, so write down receivable management. So companies can follow two types of policy. Which two types of policies? One is liberal credit policy or stricter collection policy. Liberal collection policy or stricter collection policy. Liberal means you will give more credit period, higher credit limit. Okay, more credit period is given to the customer. Higher credit limit is given. Take more credit. And stricter policy is opposite. Lower credit period. Lower credit period. Lower credit limit. So what are the advantages and disadvantages? The advantage of liberal credit policy is high sales. Sales will be high, high profit, high goodwill, high capacity utilization. High capacity utilization, lower cost because your sales will be high, so economies of scale advantage will be there. Same fixed cost will be apportioned over more quantity, so average cost per unit will go down. Is it right? Happy customers. But there are disadvantages also, like high bad debt. Risk of bad debt will be high. High collection cost, more debtors, more collection effort. High administration cost also. High administration cost, more record keeping, more documentation, more follow up. Okay, more reconciliation work. High legal cost also, because some customer may not pay, then you have to take legal action. What are the advantages and disadvantages of stricter collection policy? So the advantages would be now low bad debt. Bad debts will be less. Lower collection, administration and legal cost. But there are disadvantages. What will be the disadvantages of a strict collection policy? Sales will be on the lower side. If sales are low, profits are low, low profit write down. lower goodwill, customer will not be happy, lower capacity utilization. If sales are low, you are not fully utilizing your capacity, cost will be high. Average cost will be high because fixed cost will remain fixed only. Dissatisfied customer. Some customer who wants higher credit period will not buy from you. So they will feel dissatisfied. Okay. So the question will be asked in the exam whether we should give more credit period or less credit period, whether we should increase the credit limit or reduce the credit limit, whether we should give more cash discount or less cash discount. So the decision will be based on cost benefit analysis. Is it right? So point number 2, write down evaluation of credit policies. The question which is usually asked in the exam is evaluation of credit policy. So here we have two approaches. One is called total approach and one is called incremental approach. Total approach, incremental approach. So what we will do in total approach, we will first calculate expected profit and compare it with the opportunity cost of funds invested in receivable. Opportunity cost of funds invested in receivables. Is it right? And then we'll compute net benefits. Then we'll compute net benefits. A minus B. If A is greater than B, credit should be granted. If A is greater than B, credit should be granted. And second, if there are many alternatives, select the alternative. Select the alternative with higher net benefit. Select the alternative with higher net benefits. Select the alternative with higher net benefit. And then you have incremental approach. Under incremental approach, we will calculate incremental profit. Incremental profit means under old policy, what was your profit versus new policy, what is your profit? And then you compare it with the incremental opportunity cost. Incremental opportunity cost of investment in receivable. And point number C, you will get incremental net benefit. You will get incremental net benefit A minus B. And how do you take a decision? If incremental net benefits is positive, grant credit. Okay. And if incremental net benefit is negative, do not grant credit. And third, if there are many alternatives, if there are many alternatives, select the alternative with highest what? Highest incremental okay, okay. If incremental net benefit here is negative, then do not grant credit. If there are many alternatives, select the alternative with highest incremental net benefit. Select the alternative with highest incremental net benefit. Up to this you have written. Point number 3, write down. Calculation of fixed cost. Calculation of fixed cost. In some problem, fixed cost is not given, average cost is given, variable cost is given. So the fixed cost will be equal to average cost per unit. Depending upon the problem, then you will use this formula, minus variable cost per unit, minus variable cost per unit into number of units sold on credit under present policy, minus number of units sold on credit under present policy. So that will give you fixed cost. Then note, unless otherwise specified, fixed cost will remain constant. Fixed cost will remain constant under all alternatives. Will remain constant under all alternatives. One more formula. Investment in receivable. For calculating opportunity cost, first you will find investment in receivable. Here we have first priority. We will give it to total cost. Okay. So first priority will be total cost. That is variable cost plus fixed cost into credit period divided by 360 days, or if question is silent, take 365 days or 12 months or 52 weeks. Okay. If the question has both fixed cost and variable cost. Second is, suppose fixed cost is not given, but variable cost is given. Then variable cost or cost of goods sold is given sometime into credit period. Divide by same 360 days or 365 days or 12 months. And suppose variable cost is also not given, then we'll use sales figure. Sales into credit period divided by same 360 days, 365 days or 12 months. So this way, this is important for solving the questions. Okay. 5 write down. Average collection period 365 divided by debtors turnover ratio. In some problem, credit period may not be given. Debtors turnover ratio may be given, or 12 months divided by debtors turnover ratio. Okay. So these are some formulae that we will require in solving the questions on whether to grant credit or not. Now next concept is factoring. In this chapter, factoring. So factoring, it is outsourcing of receivable management. It is outsourcing of receivable management. All your receivable management work is outsourced to another party. So now they will ask you the question whether we should appoint factor or not. So this is a question of benefit and cost analysis. Is it right? Yes. So whether to appoint a factor or not for receivable management. So we'll have to find out what is benefit. Benefits would be reduction in administration cost, reduction in bad debts, interest saved, due to reduction in average collection period. These are the benefits, but there are costs involved. So what are the costs involved in case you appoint the factor? So you have to pay factoring commission. Okay. You have to pay for fees, interest charged by factor. Interest charged by factor. So point number C is net benefit, net annual benefit. A minus B, or net annual cost of factoring to the firm. Benefit is more than cost, you will accept the factor. One more formula write down. One more formula right below this. Point number 7. Point number 7 write down. Rate of effective cost of factoring. So this will complete your discussion. Rate of effective cost of factoring to the firm. When you are appointing a factor, you have to check how much will be your effective cost compared with some other options, and then you can compare factoring with bank and take a decision. Okay, so in this case the formula would be net annual cost of factoring. Please write down, those who are not writing. At one place you will have important discussion for exam. So one day before the exam you have to study so much. You have to study other subjects also. You have to practice a lot of questions. So read this, at least read this much. So net annual cost of factoring divided by amount available for advance. Amount available for advance. Now your question would be, what is amount available for advance? And you multiply by 100. So you'll get the answer in percentage. You are right. So this percentage helps us to understand how much is the cost of appointing a factor. He's charging us fees, commission, interest. Amount available for advance is equal to the annual credit sale. Factor will not give you full amount as advance. First he will deduct factor reserve. Some percentage he will not give it to you. If bill is of 100 rupees, he might give you only 90. Because there can be bad debt, dispute. So he will not give you 100 rupees against an invoice of 100 rupees. That amount or margin that he keeps is called factor reserve. And he will also deduct factoring commission. Factoring commission is deducted in advance. Okay. There is one alternative formula also. Write down alternatively. Effective cost, same formula, but the denominator will change, is net annual cost of factoring divided by advances to be paid. These are very important discussion which students miss out. So how do you compute advances to be paid? Advances to be paid will be equal to amount available for advance minus interest deducted by factor. Minus interest deducted by factor. So some factor will deduct interest also and pay the balance amount to you. So what ultimately comes to your pocket is this amount. So this is the amount which the company gets to utilize, and for that this is the cost that they are required to pay. Okay, we'll take one example on this later. Up to this you have noted. Can I erase it now?
Yes, sir.
Okay. Point number 8 write down. Point number 8. Interpretation of cash discount term. How do you interpret cash discount term? Understand. Example 2 by 10 net 40. So it means if payment is made within 10 days, if payment is made within 10 days, between 0 to 10th day, 2% cash discount will be given. 2% cash discount will be given. Otherwise, normal credit period is how many days? 40 days. So you have to pay in 40 days. If you can't pay in 10 days, then you pay within 40 days. If you pay within 10 days, you will get 2% discount. Point number 9, write down cost of trade credit. That means if you do not take the discount but you delay the payment, how much it is going to cost you? Is it right? So write down the formula. The cost of trade credit is discount divided by 100 minus discount. So if it is 2%, it will become 2 upon 98. 2 upon 98 into 365, that is number of days in a year, upon credit period minus interest free credit period into 100. This is nothing but the formula of simple interest only. Okay. So, for example, if suppose it is 2 by 10 net 40. For example, if credit terms are 2 by 10 net 40, the cost of trade credit will be, if you pay within 10 days, you will get 2% discount. So 2 rupees divided by 100 minus 2, that is 98. So on 98 rupees you are paying 2 rupees interest. The logic is that on 98 rupees, if you pay now, you pay 98. If you pay after 30 days, you pay 100 rupees. So 100 rupees includes 2 rupees interest. The interest is paid on 98 for how many days? 30 days. So in per annum terms, 360 divided by 40 minus 10. 40 days is credit period, but first 10 day interest free credit period. You can pay today or you can pay on 10th day, it does not matter. So the first 10 days will be called in our example interest free credit period and multiply by 100. Maji? 4.83%. So if you delay as a customer, if you delay, this will cost you 24.83%. Yes, but suppose a bank loan is available at 12%. So you can take a bank loan and pay within 10 days. So you will benefit 24.83%, but to the bank you have to pay only 12%. Is it right? So this is called cost of trade credit. Any query on this? So these are the numerical questions possible here. Now we will solve question number 5. Please come to your book. Question number 5. Question number 5. Write down question number 5. In your book you will find it. Question number 5. Mosaic Limited has current sale of 15 lakh rupees per annum. Cost of sale is 75% of the sale and bad debts are 1% of the sale. Okay, so the cost of sale comprises of 80% variable cost and 20% fixed cost. So what will be fixed cost? My question is, since you are highly talented student, what is the fixed cost of this company? 2,25,000. 15 lakh rupees the sale and 75% is the cost of sale and 20% is out of this is your cost of sale, what I have written in bracket, and 20% of that is fixed cost. So how much is that? 2,25,000. Write down here step 1. Write in the notebook also. Fixed cost in simple terms is 2,25,000. Okay, and unless otherwise specified, fixed cost will remain constant. But variable cost will change. Is it right? Variable cost will change. So now next line I am reading. While the company's required rate of return is 12%, Mosaic Limited currently allows customer 30 days credit, but is considering to increase this to 60 days credit in order to increase the sales. It has been estimated that this change in policy will increase the sale by 15%, while bad debts will increase from 1% to 4%. It is not expected that the policy change will result in an increase in fixed cost, and the creditors and the stock will also be unchanged. Should Mosaic Limited introduce the proposed policy? Analyze. Assume 360 days in a year, and see this question was given in study material and then they asked in the exam for 10 marks. Is it right? Present policy versus proposed policy. So we'll have to write down present and proposed policy, whichever gives me higher net benefit. Yes, total approach. And then we'll solve by the incremental approach also. So we'll have a revision of total approach and incremental approach. Understood? Are you with me?
Yes, sir.
Those who are not with me, yes, are against me. So write down step 2. Step 1, fixed cost you have written?
Yes, sir.
So now write down evaluation of the proposal. Evaluation of the proposal to increase credit period. Okay. So this is your present policy. This is proposed policy. And here I can write incremental also. So that will save your time as well as our time. So first you write down point number A, credit period. Anybody for credit period? In bracket, in days. First is 30 days. Is it 30 days here? 60. We are going to increase the credit period by 30 days. No problem. Point number B. Sales. Yes, students. Sales 15 lakh. Proposed policy will be 15 lakhs plus second paragraph of the question. It is estimated that change in policy will increase sales by 15%. So 15%. 17 lakh. So if you have to solve by total approach, then only two columns are required. Okay. These two columns for total approach. If the problem says solve by total approach. If the problem says solve by incremental approach, then one more column you will add. So my dear student, by what amount sales will increase here? Is it 2,25,000? 2,25,000. Point number B, write down cost. Under cost, first you write down variable cost. Variable cost. Come on, student. In the present policy, 9 lakh. How did you manage to reach 9 lakh?
Sir, 15 lakh
15 lakhs
into
into 75% into 80%. So how much?
9 lakh
9 lakh. In second column, 17 lakh 25,000 into 75%. No, just wait. How much is the variable cost to sales ratio? 60%. Variable cost is 75% into 80%, 60%. So now you take 60% of this number. 10 lakh 35,000. So multiply, sorry, take the difference. Anybody for the difference? 1,35,000. That is incremental variable cost. Point number 2, write down fixed cost. Already calculated in the step number 1. How much was that fixed cost? Step 1, 2,25,000. Question says fixed cost will remain constant. So incremental is 0. So now I will take the total of these two. Total point number C, write down. This is point C. So total of point number C. Anybody?
11,25,000.
Very good. 11,25,000. 12,60,000.
1,35,000.
Incremental cost will be 1,35,000. Point number D, write down. Wait. Bad debts in percentage. So what is your present bad debt? 1%. Proposed policy.
4%.
So point number E, write down. Here the increment is not required. Bad debt amount. Bad debt amount. You multiply sales into bad debt percentage. B into D. D. The first column 15,000.
15,000.
Second column 17,25,000 into 4%.
Sir, 59,000.
So by what amount bad debts will increase?
Sir, 54,000.
54,000. Point number F, write down expected profit. Expected profit will be point number B, sales minus total cost and also minus bad debt. Point number E, B minus C minus E. Come on, student.
प्रकट में 3,60,000.
Take 15 lakh minus 11 lakh 25,000 and minus 15,000. So anybody, what is answer?
60,000.
3 lakh 60,000. Try the next column. 17 lakh 25,000 minus 12 lakh 60,000 minus 16. 3 lakh.
96,000.
Is it 3 lakh 96,000? So by what amount your profit will increase? Your expect.
20,000.
Now suppose your question says incremental approach. Then under incremental approach, this column you have to draw. Okay? And this whatever you have written here will become your inner column, working notes, whatever you call it. Or you can write like this also. So you can write like this also if the problem specifically mentions incremental approach. If the problem mentions total approach, then incremental column is not required. If it is total approach, incremental column is not required. Matter closed. Point number F. Investment in receivable. Any other presentation is welcome if your answer is same. So let us not waste time on that. So investment in receivable, wait a minute. First write down formula below that. What is the formula we'll write? Total cost into credit period and divide by 360. So you take total cost from point number C. This is I think 11,25,000 on calculator into 30 divided by 360. 93,750. Okay, students, try again. 12,60,000 into 60 divided by 360. 2,10,000. 2,10,000. So increase in investment in receivable. Incremental investment is how much? Please tell me the difference. Don't waste time. 2,10,000 minus 93,750. If you will not answer, right, 1,16,250 is the incremental investment in receivable. So next point, this was point number G. Point number H, write down. H, write down. Opportunity cost at the rate of. What is the opportunity cost of investment in receivable? In the problem, 12%. Third line of the question. Required rate of return is 12%. So please take 12% of 93,750. 11,250. Okay. Then take 2,10,000. 25,200. Difference is 13,950. Point number I, write down net benefit. Net benefit will be your expected profit. Point number F minus H. F minus H. First column, take on calculator 3,60,000 minus 11,250. 348,750. Second column, take 3,96,000 minus 25,200. 3,70,000. And in last column, take 36,000. Take 36,000, which is your increase in profit minus increase in opportunity cost. I will also check. 22050. So this problem I have solved by two approaches. First and second column total approach. Last column is under incremental approach. So if you use total approach, you will accept the proposed policy. If you only follow incremental approach, then also it is positive. So you will say that yes, we should follow proposed policy. Understood? Write down the conclusion. Advice. Advice, write down, the company should extend the credit period because it will increase net profit, net benefit. It will increase net benefits by rupees 22,050. It will increase net benefit by rupees 22,050. Then write down one note. Investment in receivable. Note, write down, investment in receivable is based on total cost. Is based on total cost. Investment in receivables is based on total cost. This way, if you write the answer in detail, then you get full 10 marks. Okay. So if this question is repeated again, you can follow this procedure. Question number 5 is over. Now we'll come to question number 12. Question number 12. A factoring firm has offered a company to buy its accounts receivable. So this is a problem on factor. So one question I have taken on evaluation of the proposal to relax the credit period. One practice will do on factoring. Okay, a factoring firm has offered a company to buy its accounts receivable. The relevant information is given below. Question is from December 21 exam for 5 marks. This is also an exam question. The relevant information is given below. The current average collection period for the company's debt is 80 days. When the company is monitoring the receivable itself, they are taking 80 days to collect. And what is your bad debt default? 0.5%, 1 by 2. So this is 1 by 2, 0.5%, 0.5% bad debt. The factor agreed to pay over the money due to the company after 60 days. So factor says, don't worry, we will pay you within 60 days. So your credit period or collection period has reduced by 20 days. So there is a reduction in opportunity cost of 20 days credit sale. And it will suffer all the losses of bad debt also. Means once the factor takes the responsibility to recover, bad debt loss will be borne by whom? Factor. So therefore we will have saving in bad debt also. So one saving is bad debt will be reduced. Interest cost of funds blocked in receivable will reduce. So these are my benefits. And what are the costs here? Factor will charge commission. So your cost will include commission payable to factor. Actual number I will write later. Company spends 1 lakh on administration of debtor. These are avoidable costs. One more benefit. Your administration cost will also reduce by 1 lakh. Annual credit sales are 90 lakh. The total variable cost is, so this will be variable cost 80% will be required for calculating the opportunity cost of fund. Is it right? Then the company's cost of borrowing is 15% per annum. So this is your opportunity cost. Assume 365 days in a year. Should the company enter into agreement with the factoring firm? So just you have to do this 3 calculation here, 1 calculation here, you will get the net benefit. In fact, bad debt is very easy, 0.5% of 90 lakh you have to take. Admin cost is given. Interest cost you have to compute for 20 days. And commission you have to take 2% of 90 lakh. What more do you want? Should I write on your behalf? That is the only pending thing now. Okay. So write down evaluation of the proposal to appoint the factoring firm. Evaluation of the proposal to appoint the factoring firm or the factor. Okay, right hand side rupees. It's just a benefit versus cost analysis. So point number A, benefit. So what are the benefits of appointing factor? First is, first write down administration cost saved. Administration cost saved. Little fast. Yes. Any other format is welcome, but do yourself. Okay. If your answer is same and institute can understand, then I have no problem. Then write down bad debt. 0.5% of credit sale.
Sir, 1.30.
Credit sale is 90 lakh. Is it 45,000? And one more benefit you write down. Reduction in interest cost. Reduction in interest cost. How do you compute that? How much is your credit sale? 90 lakh. Your collection period will reduce from 80 days to 60 days. 20 days saving. The problem says take 365 days in a year. This you multiply by 80% because variable cost is 80%, or you can first multiply 80% of 90 lakh here, no problem. And the opportunity cost is at the rate of 15%. This is your opportunity cost or rate of return, and this is the variable cost. Final answer 59178. Point number total A, write down total A. This is your total benefit if you appoint the factoring firm, 2,04,178. Point number B, cost. So under cost you have factoring commission, only one cost. Factor will charge you 2% of 90 lakh. Is it 1,80,000? So point number C, net benefit. No, he's not charging you, he's not giving you advance, he's only providing you collection service. And he says if I do the collection, I will reduce your credit period by 20 days, and I will reduce your bad debt, and I will reduce your administration cost. So give me the charge of collection, and I am charging 1,80,000, but then company is going to benefit so much. 24 Very simple, logical.
means in that previous problem, he used to
In
give
an
us
earlier
one.
problem, he had given me advance, so we had to also consider interest here.
Oh, yes.
But he is not giving us advance. If the factor provides us advance, then we have to also compute the interest cost. Okay, write down conclusion. Conclusion, write down, since net annual benefit is rupees 24,178. Since net annual benefit is 24,178, the firm should appoint the factoring firm. The firm should appoint the factoring firm. The firm should appoint the factoring firm.
Yes, sir.
Note, opportunity cost on investment in receivables. Opportunity cost of investment in receivables is based on what? Variable cost. Based on variable cost. Is it right?
Yes, sir.
So now we'll go to one more question. Kindly come to question number 8. So the students will come to one more question. Again a different variety. If you solve many varieties of question, then only you can think of getting through this exam. Okay. Only by dancing in the classroom, mugging up the formula won't help you. Understood? Is the message clear? This is financial management, not a joke. So let us take it seriously and solve. And only you can get through in the exam by solving so many different varieties. So let us go to question number 8. A company is considering its working capital investment and financial policies for the next year. Estimated fixed asset and current liabilities for the next year are, estimated fixed asset is given and current liabilities are 2.60 crore and 2.34 crore respectively. Estimated sales and profit before interest and tax, EBIT means earning before interest and tax, depend on the current asset investment, particularly inventories and book debt. The finance controller of the company is examining the following alternative working capital policies. It's more a chapter of working capital. Okay. Next is working capital policy. There are 3 policy options: conservative, moderate, aggressive. In conservative policy, you will keep more current asset. In moderate, between conservative and aggressive. In aggressive policy, less current asset. Why to unnecessarily invest in current asset? And these are your estimated sales level. And this is your estimated EBIT. Okay. After evaluating the working capital policy, this is going to be my working capital policies. The finance controller has advised the adoption of the moderate working capital. Underline, tick mark. So finance controller says, okay, let us follow the middle path. Moderate policy. The company is now examining the use of long-term and short-term borrowing for financing the asset. So now what they have decided to follow moderate policy, but then they have to raise funds also. So what is the funding? They are going to use both type of funds, long-term, short-term. The company will use 2.5 crore of equity funds. Corporate tax is 35%. Company is considering the following debt alternatives. So how to finance your working capital? So financing policy, conservative debt, short-term debt 0.54, long-term 1.12. Moderate policy 1.66. Aggressive policy, short-term debt will be more, long-term debt will be less. Interest rate on short-term debt is 12%. Interest rate on long-term debt is 16%. So now what is the question? Question is, you are who? You are required to calculate the following: working capital investment for each policy. So working capital investment for each policy, that is, what is the net working capital position? Net working capital position means current asset minus current liability. For each policy means moderate, aggressive, conservative, and then rate of return for each policy, and then current ratio for each policy. Current ratio means current asset upon current liability. Then you have to calculate for financing of each policy what will be net working capital position. That means after considering short-term debt also, what will be your net working capital position. Now you will also consider short-term debt in the current liability. Then rate of return on shareholders' equity. Rate of return on shareholders' equity means you have to find out earning after tax divided by shareholders' fund. And for calculating earning after tax, you have to deduct this interest also. Deduct the interest also. Deduct tax also. Then you will get earning after tax, and again compute. Come on. Current ratio. Current ratio. So you will ask me, sir, are we not computing two times? No. This is based on this original table, conservative, aggressive, moderate, without considering the financing. And then we are going to consider financing, where I am going to take three different financing strategy: conservative financing strategy, moderate financing strategy, and aggressive financing strategy. Okay. So question is little lengthy because you have to compute three times, three ratios under two situations. Okay. Highly important question. Source of the question is not your study material. Everything is not in the study material. November 18 RTP, May 19 RTP. So what is the next station? Exam. You're right, sometimes. So first we will write down, first heading write down, statement showing step 1. Only with pre-practice you will be able to understand what is the question. Otherwise many students will not understand only what I am supposed to do. Statement showing working capital for each policy. Working capital, that is your first question. Statement showing working capital for each policy. Here each policy means the first table where the company wants to have conservative policy for working capital with more investment in current assets. Moderate policy means somewhere between conservative and aggressive. An aggressive policy means you want to keep less investment in working capital. Okay. So are you ready? No, you have to draw 3 columns on the right side. Haji. Serial number, particulars. And there are 3 working capital policies. Conservative, If you write along with me, you will get more benefit. If you only stare at the screen and think you are genius, institute will show you your true color. Okay? Better to write in the notebook and practice.
Yes, sir.
So, assuming you are ready. So, first question is to find out net working capital position. Right now, we'll not consider how the working capital will be financed. Okay, that is for my next answer. The effect of financing policy on different ratios. First, write down point number A, current assets. Refer the first table and tell me current asset in conservative policy. 4.50. At the top, write down rupees in crore. Right hand side, top right hand side corner, rupees in crore. Are you with me? What is your working current asset in moderate policy? First table. Yes, these are called working capital policy. Conservative management will keep more current asset. Aggressive will keep less current asset. Point number B, write down fixed assets. Fixed asset is given in the paragraph number 1, 2.60. Is it there, 2.60? So this will give me total asset, point number C. Because we have to compute return also. So total asset would be A plus B. 7.1, 6.5, 5.20. Point number D, write down less current liabilities. Less current liabilities, which is printed in the first paragraph in the second line. Question in front of you. Without question, you won't understand. 2.34. Right now, we'll not consider financing. Okay. That long-term debt, short-term debt in the next answer. So point number E would be net worth. Assets minus current liabilities net worth. C minus D. 4 point. Then 4.16. 2.86. Okay. Point number F, write down sales. Sales figure is given in the first table. 12.30, 11.50, 10. Point number G, write down EBIT. That is also given. Check and tell me. 1.23, 1.15 and 1. We have written all basic numbers. Okay. Now we'll compute the ratios. First they are asking you net working capital. Net working capital position. First question. Question in front of you. So A is current asset and D is current liability. A is net working capital means current asset minus current liabilities. Kindly reply. 2.16. Okay, very good. Very good. 1.56. Then 0.26. Then second, write down what is the second ratio, rate of return. Rate of return. So rate of return will be your EBIT, which is point number G, divided by net worth, point number E. Rate of return on net worth, write down 25.84%. Then 27.64%. Then one more, write down point number 3, rate of return on total asset. Rate of return on total assets, which will be G upon C on total asset. They have mentioned compute rate of return. Not very clear, is it on net worth or is it on total asset? 17.32%. 17.69%. Very good. 19.23.
Yes.
One last point, write down, which is current ratio. Current ratio A upon D. A upon D, write down current asset upon current liability. 1.92. Next column 1.67. 1. Now see, the purpose of doing this exercise is to tell you, in conservative policy liquidity is good, but profitability is low. Whereas in aggressive policy, the profitability is high, but the liquidity is low. And in moderate approach, it is between conservative and aggressive. So company has decided to follow moderate approach. Now once they have decided to follow moderate approach, the next is how to do the financing of current assets and current liabilities. So for that, again, there are three approaches with respect to financing also. With respect to financing, now there are three approaches: conservative, moderate and aggressive. Now this conservative, moderate and aggressive is with respect to financing of working capital. Conservative approach, less short term, more long term. Okay. An aggressive approach, more short term, less long term, because short term is available at a lower rate. Long term is available at a higher rate, so I will go with short term more. Now the student is asking, why long term rate is more than short term rate? This is market. Depends on economic situation. Short term rates are lower than long term rates. So usually that is true. Okay. Sometimes it can be reverse also. You are a student right now, so your question is genuine, but whatever they will give you, follow. So first, based on this analysis, company decided to follow moderate approach. So these are the assets and liabilities this company will have. Understood? Moderate. Under moderate, now we'll have three columns again with respect to financing. With respect to financing. So step number 2. Step number 2, we will write statement showing, which is your question number Roman 2, statement showing
Means we have
Effect of
selected moderate policy,
hmm,
and that moderate policy, financing policy, which one will be?
first moderate policy with respect to how much current asset we need to carry. Once we have decided that, then how it will be financed. Under that also we have three choices. Short term is more, long term is less, short term is less, long term is more, and moderate approach. Okay. So statement showing effect of alternative financing policy. So here the financing policies are of three types. To write down financing policy. Under that you write conservative, moderate, aggressive. To write little fast, I will highly appreciate if you write fast. Concentrate on the question, keep the calculator ready. Draw one page. Take a scale, draw one page. It's a lengthy working note because we have to compute net working capital position, rate of return on shareholders equity and current ratio. But in case if I am also taking financing, I have to consider interest rate. I have to consider taxation also. Since I have to compute rate of return on shareholders equity, I need to reach up to PAT. I need to reach up to PAT. Point number A. Current assets. So tell me how much current asset will I write? Company have decided to follow moderate working capital policy. So in the moderate working capital,
3.90.
in the moderate working capital, it is 3.90. So that will be 3.90 in all the columns. Right hand side, top right hand side corner, rupees in crores. Presentation is equally important. Then we'll get full marks. Point number B, fixed asset, which is already fixed, 2.60, 2.60, 2.60. Point number C, total assets, A plus B, with the calculator ready. So that comes to 6.5, 6.5, 6.5. Point number D, current liabilities. So what is the current liability other than short-term loan? Other than short-term loan. Anybody who wants to volunteer? 2.34, 2.34, 2.34. Now the answer will start changing. Point number E, short-term loan. Short-term loan, refer your question under different financing policy. Short-term loan is 0.54. Can you see 0.54? Then 1 and 1.50. Can you see that in the question? First check, then write. I'll show you. Some of you are looking lost. 0.54, 1 and 1.5. This is what I am talking. So can I calculate current liability again? Point F, current liabilities, including short-term loan, please add D plus E. Current liabilities including short-term loan, 2.88. Very good. 3.34, 3.84. Stop. Any query till now? No query. Point number G, write down long-term debt. Long-term debt. Long term debt is how much? According to this question, conservative policy 1.12, 0.66, 0.16. Point I write down total liabilities because I have to find equity also. So total of the liabilities will be 444. Is it 4? Point number J write down equity shareholders fund. Why do I need this? I have to compute return on equity shareholder fund. So on the screen, this is my total of the assets. This is my total of the liabilities. Okay. Total liabilities write down F plus G here. So equity will be P minus I. So are you getting 2.5? Any other presentation is welcome if your answer is same. This I will require in the calculation of return on equity. Is it right? Point number K write down sales. So now I am going to find out PAT. I am going to find out PAT. Sales is given how much? In moderate policy, and we will keep it constant because this is under moderate working capital policy. These are the three financing policies. Is right? 11.5. So what is EBIT in moderate policy? 1.15, 1.15, 1.15. For your understanding, you can write in bracket for moderate policy. Because the company has decided to choose moderate working capital policy, and now they are evaluating what should be financing policy. Okay. So from EBIT you need to deduct two types of interest. So how many points we have written? How many points we have written? L. Now write down M. Interest. Under interest write down A. On short term debt at the rate 12%. In the first column you will take 12% of short term debt. 12% of short term debt is how much in the first column? 12% of 0.54. Come on. In two digits only. In two digits only. Yes, only in two digits. Please do not waste more time. 0.06 is right. Go to next one. 12% of 1. Very good. 0.12. Next one. 0.18. Presentation is equally important. Point number B. On long term debt at the rate 16% on long term debt. At 16% on long term debt. 16% into 1.12. 16% into 1.12. 0.18. Only in two digits I want. 0.18. Next. 0.12. 0.12. 0.02. Check the rounding off properly. 0.3. So can I make it 0.3? Now just total of this interest. This I will call total M. Total interest. 0.24. 0.24. 0.21. Okay. And write down EBT. EBT, EBIT minus interest,
L minus M.
L minus M.
So 0.191.
0.91. Come on, next one.
So 0.91.
0.91. Come on, next.
0.91. No, 0.12.
Is it second one is 0.91 or 92?
0.91.
Okay, 91. Last column.
0.94.
0.94. Okay, okay. Point number O, write down. PAT. PAT will be
5%
EBT
100 minus 0.5%.
into 1 minus, what is the tax rate?
35%.
35%. So you
1 minus
multiply by 65%
0.6.
and answer in 2 digits. So PAT will be 0.59, 0.59, again 0.59, 0.61. So we have computed all your main workings. Now ready to reply to your ratios. Ratios. Which are the ratios they have asked? First ratio is net working capital position. Net working capital position. So I will have to take current asset, which is point A, minus total current liability, including short-term loan. Okay. So you'll have to take A minus F. A minus F. Write down A minus F. Student will reply A minus F. Current asset minus total current liability including short-term loan. A minus F. 1.02. Okay. 1.02. 0.56. Very good. Come on, next. 0.06. What is your second question? Rate of return on shareholders' equity. Rate of return on. Please practice such question, okay? Otherwise in the exam you will not be able to visualize the format. Point number O, that is, okay, write PAT, otherwise you will think it is 0. PAT divided by shareholders equity into 100. O upon J into 100. 23.6%. 23.6% is right. Yes, come on everybody.
3.6%.
Second column is how much?
24.4.
Is this 24 point?
That is 23.6.
23.6 only.
0.5.
Okay. 23.6. Maybe some rounding of difference is there, huh?
24.4%.
Okay. Okay. And one more, write down current ratio.
ये होगा A upon F.
A upon F. So try A upon F.
1.354.
1.354. Okay, next.
So 1.17.
1.17. 1.015. Very good. So again the observation is, in aggressive policy the return is high but the ratios are very poor. Liquidity is poor. In conservative, return on equity is lower but the current ratio is more than 1.35. So, so one has to compare under different policies and then choose what is more suitable for you. Okay. So in this example, the company may follow moderate working capital policy, but conservative financing policy. But conservative so that at least their current ratio will remain more than 1.354. So it should have a good working capital position. Okay. Or they can even follow moderate financing policy. In that case, the current ratio is very close to 1. So that again depends on your risk taking ability. But is it right? So this answer is over. We are not required to make any comment. So with this wonderful answer is over. I hope you liked this chapter. Liked? Enjoy.